What's up guys, welcome to my channel on passive income investing. My name is Adrian, and today's video we're going to talk about diversification. So it's a very important term that you've probably heard many times by your banker or financial advisor. So we'll do a deep dive on what diversification is, why is it important when it comes to investing. Alright guys, so first things first, let's check out the definition of diversification by investopedia.com. So diversification is a risk management strategy that mixes a wide variety of investments within a portfolio. So a diversified portfolio contains a mix of distinct asset types and investment vehicles in an attempt at limiting exposure to any single asset or risk. So the rationale behind this technique is that a portfolio constructed of different kinds of assets will, on average, yield higher long-term returns and lower the risk of any individual holding or security. So in this presentation, we will review the three main branches of diversification when it comes to investing. So 1, sector diversification, 2, asset class diversification, and 3, region diversification. All right, so when it comes to the sectors of the stock market, there are a total of 11 sectors. You have energy, you have materials, there's industrials, consumer discretionary, consumer staples, you have the healthcare, financials, information technology or simply technology, communication services, so those are the telecommunication companies, you have utilities, and last but not least, real estate. So just to give you an example, I put a chart here of the breakdown of the sectors on the Canadian market or the TSX. So as you can see here, 33% of financials, a big chunk in energy, as well as a big chunk in materials. So this makes complete sense for Canada because it's a big country. There's a lot of natural resources, especially in the oil and gas sector, especially in Western Canada, and you have a lot of gold mines as well. So there's a lot of material stock. So this is the snapshot of the Canadian stock market. The US one would look a bit different. There would be a lot more in healthcare, a lot more in technology, because a lot of the biggest technology companies in the world are in the US, and they also have a lot more healthcare companies, pharmaceuticals, things of that nature. So that's just an example. So what we'll do now is go over each sector in detail one by one. Let's go through these sectors one by one now. So first is real estate. So this is residential, commercial, or industrial real estate. And the biggest example are REITs, so real estate investment trusts. So in terms of profile, the risk is pretty low. It's considered a defensive sector because real estate is essential, especially the residential REITs. Everyone needs shelter, right? So it makes sense. In terms of dividends, it's a really good source of dividends. They all pay a dividend by law. So they have to pay 90% of their income in the form of dividends. So a really good sector here when it comes to getting a stable dividend. Second sector is energy. So this is the production and supply of energy. So mostly oil and gas companies like ExxonMobil or Enbridge. So in terms of profile, these are volatile because this sector almost exclusively correlates with the prices of oil and natural gas. So small to medium-sized producers are especially risky because it's harder for them to compete with larger producers, so they fluctuate a lot more. So definitely not for the faint of heart here. In terms of dividends, they are a good source of dividends, but they are at risk if oil prices drop too low. So if you're really after the energy companies or the dividends, I would suggest sticking with the midstream companies because they tend to have safer dividends. These are the middlemen, so they focus more on the transportation and processing of oil instead of the production and extraction of oil. Third sector is industrial. So it produces and provides services for machinery, equipment, and supplies that are used in construction and manufacturing. So an example would be construction companies, aerospace companies, manufacturing companies. So pretty volatile during economic downturns, but it really depends on the company. For example, during the current COVID-19 pandemic, aviation and aerospace stocks are getting hit pretty hard because of the travel restrictions. So in terms of dividends, it really depends on the company. Some provide a good dividend, but it really depends on their cash flow. Consumer discretionary, so these are non-essential goods and services like travel and leisure or entertainment companies. So these are pretty volatile because, especially during economic bad times, because they're non-essential products and they tend to be cut very quickly or they get cut first by consumers. So this sector really thrives when the economy thrives. So that's when people tend to splurge more on non-essentials. So in terms of dividends, it really depends on the company. Some provide a good dividend, but it really depends on the stability of their cash flow. Okay, so consumer staples, this is the opposite of consumer discretionary. So these are the essential goods and services like food, beverage, household goods. Companies would be like Coca-Cola or grocery store chains, things like that. So this is, in terms of risk, it's much lower risk. It's a defensive sector as these are essential services no matter what the state of the economy or the stock market is. In terms of dividends, they are known to provide some pretty steady and growing dividends to shareholders, although the dividend yields are fairly lower. Healthcare. So this is medical services. So medical care, supplies, or insurance companies like pharmaceuticals or long-term care facilities or retirement communities. So this also is pretty low risk. Considered a defensive sector as these are pretty much essential services no matter what the state of the economy is. And in terms of dividends, they are known to provide steady and growing dividends to shareholders, especially the insurance companies and healthcare facilities, as the revenue is fairly stable. So a lot of exposure to the US market here. Telecommunication or communications, one of the safest sectors of all. So this is phone and internet service providers, voice and data providers like Bell Canada, TELUS, AT&T, or Verizon. So these are very safe. It's a defensive sector because voice and data services, phone and internet, they're essential no matter what the state of the economy is. It's a well-known sector to provide really good dividends that are steady and growing. So a really good defensive sector here. Same thing with utilities. I mean, these companies provide the basic amenities like electricity, water and sewage services, and natural gas. So some big companies would be Duke Energy in the US or Hydro One in Canada. So very, very safe. As these are also essential services. Everyone needs electricity, right? No matter what the economy is doing. And this sector is also very heavily regulated by the government, further providing stability on these companies. So dividends are known to provide steady and growing dividends to shareholders. So these two sectors especially are pretty much the safest in terms of sector. Financials now. So financial services, which is a big part of the stock market in every country. So banks, investment firms, and insurance companies, things of that nature. So relatively safe overall, especially the bigger banks. But they could be volatile during economic downturns or financial crisis like in 2008. I'm sure you all remember that. So this sector is really dependent on the money they make from loans and mortgages. So it really depends, they're dependent on the interest rate. So as interest rates fall, they make less money. So they're well known to provide really, really good dividends and growing dividends to shareholders. So a really good source of dividends here. Technology now. So technology or companies or the sector basically that provides technology-based goods and services like Microsoft, Apple, Google, IBM, etc. So pretty volatile, but becoming more and more safe actually because technology is becoming more and more essential in everyday life. So it's good. They're more known. They're not known as much for their dividend, but they're known more to provide growth for investors. So capital gain appreciation here. So so dividends, they pay very low dividends or none whatsoever because they typically reinvest their profits into innovation, so R&D, research and development. The last sector, but not least, is materials. So these are raw materials companies like precious metals, chemicals, or forest products like lumber, things like that. So this is pretty volatile, but I say with a twist here because the stock or the companies, they correlate heavily with the price of the material they deal in. So if they deal with gold, it depends heavily on the price of gold, lumber with the price of lumber, etc., etc. So I write with a twist here because gold is actually a safe haven for investors during economic downturns. So when there's a big economic downturn, investors tend to shift their money to gold because it's very stable. So dividends, it really depends on the company, but gold producers are not known to provide big dividends. They usually have a very low or no dividend at all. So this sector is more for kind of like a hedge against the stock market, so to speak. So when it comes to asset classes, there's four main categories. You have equities, which is going to be the biggest category if you're an investor in the stock market. So this is basically stocks, so shares in a public company, or also funds that have shares in a public company. Second one is fixed income. So this is a bit safer than stocks. So bonds make up primarily this category. So either government bonds or company bonds, and also preferred shares fall in this category as well. Third category is alternative investments. So primarily real estate will fall under this category. So REITs, real estate investment trusts, but also other things like physical gold, art, antiques, coins, things of that nature. And fourth, the safest one of all, basically cash equivalent. So cash savings account. If you're in Canada, GICs will fall under this category, so guaranteed investment certificates, or in the US, they have certificate of deposits or CDs. So region diversification, this is the last type of diversification I want to talk about. So it just basically means you're holding securities from different regions of the world. You don't want to put all your stocks or money in a single country or region, for the same reason that you don't put all your money in one company. Basically, if that company fails or that country fails, well, your portfolio is in big trouble. So this just further provides safety and reliability for your portfolio. So there's three main markets. There's North America, which is US and Canada. You have Europe, a lot of developed countries there, so UK, France, Switzerland, Germany, etc. And you also have Oceania and Asia, so China, Japan, India, Australia, a lot of good, powerful economies there as well that you want some exposure to. So that's basically it for region the diversification. It's pretty simple. You don't want everything in one country or one region. So that's the end of the video, guys. I hope you learned something and now you understand what diversification is. Please make sure to hit the like and subscribe button. I would really appreciate it. And don't forget that you could download the whole presentation by clicking on the link below. So thanks again, guys. Take care and see you next time.